Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The market since mid-January has run down along the underside of the purple highlighted upper time, currently at 1969 of the early November 2023 to mid-January 2024 bearish shift pitchfork for a large part of its time. In late February for a few days and then again in late March until early April, there had been a strong drive higher over the upper time, but the move failed and the bearish shift pitchfork repaired itself. The first time up was halted at the overhead congestion between 2390 to 2408, and the second time by the combination of the congestion in the 2235 area, the declining short medium moving average currently 21 even, and the influence of the declining medium moving average currently at 2172. Prices 5 weeks ago started pushing down through the familiar stratified congestion zones between 2140 to 2148, 2107 to 21 even, 2069 to 2076, 2047 and 2003. This general zone between 21 even to 2010 or just slightly below it also features as a congestion area back between January to February 2017. By Thursday 5 weeks ago, prices had pushed down within the purple highlighted bearish shift pitchfork and then down through the pink highlighted April 2021 to April 2024 uptrend, currently at 20 1/4, all the way down until the bright red highlighted April 2020 to date uptrend, currently at 1934, and just short of the bright green 2022 to date uptrend, currently 1884. The market staged a small turnaround 4 weeks ago, but to be honest, the turnaround has been, to put it mildly, modest, with the market being capped by the broken pink uptrend and the March 2023 low at 2004, and supported by the breached bright red uptrend and broken light green uptrend below. In all this, I said 2 weeks ago, and I quote, "It looks like the bearish purple shift pitchfork might have started to reassert itself, but I give it a few more sessions to verify," end of quote. Now, overshadowing all of this is the monthly key reversal down pattern that I'd warned about 2 weeks ago coming to fruition at the end of April. There are two final patterns that I would like to discuss once again, as I said 2 weeks ago. And I said at the time, and I quote, "The first is the late February to date bear channel highlighted in dark blue on my daily chart, currently 1834 to 2132. It is still somewhat nascent, but it deals with the price action outside and above the purple highlighted bearish shift pitchfork rather well. I will see how this idea develops, but as I said, right now it looks good. Then there's the action of the last 2 weeks, and I'm wondering if this, so that's 2 weeks before, that's 4 weeks before, if this is becoming a bearish halfway hesitation or bottoming action of some sort. Right now, I'd edge towards the bearish halfway hesitation, but it's still very, very early on this idea," end of quote. Well, the bear channel has developed and is still there, driving prices lower. However, we have not pushed lower or turned higher until today of all days. Today, the market has taken a flyer on the downside, with the lowest low so far since November 2022. Still too early to call this move the second leg in a bearish halfway hesitation, but it will be worth considering next time, especially as prices have just moved below the bright green uptrend. Thus, it is time to consider what is in the way below. And apart from the lower bear channel line and the middle time, I would look at the 21st century absolute Fibonacci line at 1809. Ice Europe white sugar in London. The market from the middle to end of January had been wading through stratified layers of support and turning into resistances above, such that prices have dropped down to below the interesting 625.30 to 602.70 congestion area, and also down below the purple colored uptrend, currently at 613.30, dating from October 2022. There was some further congestion below between 590 even to 592.80, but the changeover gap in mid-April ultimately took care of that, with prices opening the lowest since March 2023. This new gap had prices down below the recent stratified supports and into open territory that just had the February 2017 high nearby at 565 even, and then really nothing until the March 2017 high at 548.70. Well, the market realized what this looked like on a continuous daily chart such as mine and stabilized for a bit, though not managing to even start filling in the gap from 613.40 down to 580.30. Now, there is always a tendency for markets to fill in gaps, including changeover gaps such as this, though, and I would quote my commentary from 2 weeks ago when I said, I would not suggest holding your breath for this one to happen, end of quote. This brings me to a point I raised 4 weeks ago, and I quote, over the last few weeks I've been voicing a question here that I've been posing to myself. It is this. Is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern? Last week it was still too early to tell, but I'm confident now that the late December 2023 to date action is perhaps a possible descending triangle. I've outlined the triangle on my daily chart in bright red, currently 594.80 to 651.5. This is a pattern to watch, just in case it morphs into something else, end of quote. Well, 2 weeks ago, I was unsure about this pattern purely because I do not like the changeover gap that caused the market to drop below and out of this pattern in the first place. It didn't mean it wouldn't work, it's just that, well, I'd rather it move down during the course of normal trading rather than this way. However, I added the following 2 weeks ago, and I quote, now that we are here, it would seem appropriate to set out some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, a primary target X for such a pattern, it would be down in the 544.80 zone, whilst a harder secondary target X1 will be down in the 497.60 zone, which is then off the bottom on my daily chart, end of quote. I further added, and I quote, I'm unsure about this one and I'll watch it with great caution. I would only now add the small postscript that the action over the last 2 weeks or so has grown to become possibly either a bearish halfway hesitation or a bottoming action of some form. Here likewise it is too early to tell which it may be, if any, though I have a natural disposition to look at it as a possible bearish halfway hesitation. But I could so easily be wrong, end of quote. Well, today the market looks much more likely to be a bearish halfway hesitation despite the changeover gap, as prices approached and have just punched through as I speak the April low of 555.80, 555.80. This changeover feature also, gap also features in one other recent feature of the market, and that's the monthly key reversal down in April. Without the changeover gap, this would not have happened. So as you can see, there's a lot riding on this one singular gap. Sugar white premium spread. It must be over a year now that I've found many things still going on this daily chart all at the same time. And so I had previously spoken some while ago now about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021 highlighted in dark blue on my weekly chart. With the lower time below, currently at 137 even, tested but not broken, even over the last 4 weeks. We also have down there many of the moving averages between 130 and 3/4 and 140 and 3/4. Above, we have the congestion between 162 and 3/4 to 164 and 3/4 that had, until recently, the rising neckline extension of the June 2021 to May 2022 reverse head and shoulders bottom currently at 165 3/4 running through it, plus the 2012 high at 164 and 3/4. There's also further congestion above between 173 and 3/4 to 175. Now after this we have a pretty clear topside over congestion at 178.5 all the way up to the dark blue middle time, currently at 211.25 of the same bullish Andrews pitchfork. 4 weeks ago the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless still effectively countered the previous week's bullish closing white Mariposa. Back then I also considered topside targets for the big elephant in the room, the big February 2022 to August 2023 diamond top pattern highlighted in dark green on my daily chart. Thus a primary target X, which isn't that easy to reach, will be in the 250 area with a secondary much harder to reach target X1, a much harder to reach target up in the 291 even area. I added, and I quote, "You can see my finessing these at some point as they are currently both off the top of my daily chart. Off my weekly chart," end of quote. Well, 3 weeks ago we had enough of the dreaming, and I decided that we'll stick to the cold, hard, immediate reality and consider the dark blue lower time along with the nearby moving averages as the key element in this market, and no more than that for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.